can you see the wicked spreadsheet at a glance that there in front of you? Yeah. Okay. So what we have here is we have a section on the top here, which is which gives this bit gives the income, and this area gives the build costs. This is your sort of year by year, year 1, year 2, year 3, going up to, I think, going up to year 30 of sort of mini profit and loss. And this gives you year by year balance sheet down here. I will come in and sort of zoom in that in a moment. There's some critical success factors up the top here, or sort of critical monitors rather, that are up the top here, which we can actually put those into one place so we can pull those out, and you can put them into a comparison table, because you could run what if scenarios. You know, what if we upped the rent by this amount? What if we got a loan that was this amount? And we've sort of, the numbers can come out into this section here, and we just copy those and paste special as values, and then that you can sort of have them sitting next to each other. And we have actually, because of that, we've created a second sheet where you can input those values into there. It sort of starts, as far as working around the sheet, it works around like this. So you start here and you work around like this, and then you look at the financing, which is grants, and the grant financing, which is loans here, and shares. I think I might, just to make it easier, just go through a few of these slides which focus in on each of those sections. So it will go, these are the parameters, these are sort of the basic inputs that we've put in ourselves. So and about price per square foot, and for rental, and price for refurb, etc. Corporation tax rates, things like that. And then this bit here, which is about actual income, this bit here, which is about cost of refurb. So it goes round like that, and then you can start to see the results down here. There is a key to it. Oh yeah, here's the key. And the yellow cells, it says on the key, are important. Sorry, the yellow cells are input cells. The green cells are input cells, but they've got default numbers in. You can overwrite them. And the pink cells are very important result cells. That's the coding, but it's in there. I'm gonna just go on to next. Oh yeah, great. So I forgot that was yeah. So that's the code. So building details and namespaces up the top there. I forgot this did this. Assumptions made, including known build costs, meters squared, rental rates, in feet squared, area calcs. So this is the order, and then there's this sort of potential grants here where you put in what grants you're going for, and then a percentage likelihoodness of you getting those grants, whether that's down to 5% or 100%, to give you an idea of what your expected income is. Of course, it's all very rough. The total cost is up there of the actual build, and the loans, social investment, and community shares information is up the top here. And then it comes down here. We've got the profit and loss calculation for 30 years. And there are hidden rows in there which you can access. Nothing's really hidden. And the yellow line is the community wealth calculations, and that's an important yellow line. Oh, sorry, I think that's a pink one, but yeah, that's balance sheet projections, including a spreadsheet line checker. So the pink line is the cash in the bank, and that's an important result cell, obviously. So final calculations, including community wealth calculations and share movements. So if I just, there's the key on the left-hand side. So what I've emphasised at the beginning is this spreadsheet doesn't represent the full cost analysis. So don't be scared by it. It is quick and simple. And once you've done it once, it's actually much easier to do it a second time. And we have examples. The spreadsheet has several sheets because there are examples in there that you can use, and it's sort of pre-filled to a certain extent, so you can overwrite with your own numbers. Being careful not to overwrite the calculation cells. It's not locked in any way. So yeah, you use it to suss out possible projects. So just to take you on a tour, so there's the bit that I was saying. The important bit for me is this: is the yellow, is the white ones. Is leave those ones, don't, because that will break it. And but as long as you've got a template, you can just start again. So working around with the inputs, we have cooperative department store, the floors and areas. You can specify what you want to be in the as your area. So you can just, there's an ability to put 3 different types of spaces in there, and here's got 3 different types of things within that. And on the assumptions, these are the assumptions you start off, and these have been pre-filled. So we're assuming that there's a letting agent fee of 10% on there. Inflation is 0 for the sake of this, but we can put in another number. And tax status is 0% because it's a charitable community benefit society, but you would normally put 19%, or maybe even you would look to raise that up because of the corporation tax rise that's going to happen. And then a factor for things like you might have so much area, but actually there's a certain amount of space which you can't rent, and there's also times when you have voids, so you can't rent those spaces. And these are blankets, so you won't be able to do a certain amount for one and a certain amount for the other type of space. This is again, these are sort of the parameters that are preset, but you can change. So it's got the usage type. So for if it's office space, we put in £12 per square foot, and for community rate, that's £6 per square foot. So that's per month, and affordable accommodation is £10, etc. Build costs is different types of build. So if it's a heritage, we're saying, and we've talked to architects to get a reasonable breakdown on these, but they're total guesswork. But it's to establish feasibility. So heritage, we've got £2,500 per square metre is a cost for that, or just a refurb would be 500. Area calculations, and you just put in the numbers there of what the space is, and that's in meters squared, and that will calculate it into it will look at the reduction in space because of the void area, not the voids, but the unusable area. So it comes out with an amount. Oh, sorry, I've just clicked on anyway. So come on. So this is the grants I mentioned earlier. It's the grants table. So you put in the likely grants. You then put in a likelihood of success, and so it sort of tops up. So if all your grants came through, you would end up with 2,700. If some of your grants came through in proportion to the likelihood, then you would get that amount. And so that's the amount that we use. If you have one which was $1 million and was very unlikely, it might skew things if it suddenly came through, or it might skew things full stop. So there's a problem with estimation of that type, but we're trying to get something which just gives us a flavour, really. And then we come on to in the top left, into the calculations. So you have the community, the ground floor rental, and we've got a refurb price, which has been calculated from below, because it's in here you use a pull down list to say what type of build is needed. So a remodel build, and it will multiply the number of square meters that you've put in by the amount it costs for remodeling, and it'll come up with a price. And likewise for the first floor and for the second floor. So you get an idea there of the cost which is involved, likely cost. And then the income space, you've then got that space is being used for community retail. So that amount of space for community retail, you set that at whatever price it was before, and that will work out what your annual income is going to be. The first floor is going to be co-working space, and multiply the space by what you've got for co-working, and you come up with this number. They're green cells, so you can overwrite them if you actually go, no, we're not going to earn that. This is what we're going to earn. So you can overwrite the formulae, and that of course breaks it at that point, but it will give you if you have better knowledge than the model does, then put that in. And the last one is the upstairs affordable accommodation, and so you've got a space and you've got a price for affordable accommodation per square meter, and that comes out as that. There's also ability to put other income sources in there. So there's other capital costs you could put in, and other income to add up to things which actually we can't formalize. This is very formulaic, and this bit isn't. So you've got the purchase price. Oh, great. How do I go backwards? Put the purchase price and the other costs in there. So other costs which are incurred within that purchase. And so then you have the total costs, including refurb, purchase and fees there. And here you've got your grants which are available. So you've got purchase price and grants. And so we know the difference between these two. We've got 419,200 to find. So so this is what I was saying about the yield. So if you've got the value, the total cost of purchase is 1,624,000, then, and you know that the estimated income is 70,000, then you know that actually the yield is 4.36%, because that's 4.36% of that. And if you were to say actually you want a yield of 6.5% based on this turnover, the actual value is 1,089,000. So you can actually say it's not worth that amount of money in there, because for a developer. So if you're looking at it from a developer's eyes, it wouldn't be. However, because you've got grant income in there, it actually changes the equation and makes it much more, it makes it affordable. As a financial proposition, it doesn't work, and a developer wouldn't touch that with a barge pole. As a social enterprise that's able to access grant funding, it is actually, it changes the scale. Could almost actually, on this, change that amount, because it could almost relate to the amount that you spend after grants, but because the grants aren't guaranteed, we don't put that in. We don't put the we base the yield on the actual cost rather than the cost less the grants, because the grants are sort of in the mix really. So that's the yield section, and from sort of first glance here, you could say it's not viable. But one of the things we do know is that there is a sort of, this is really the price it's worth based on that turnover. So anything above that would have to be grant funded, or you've got a good case to grant fund it. So there was that shortfall of £419,200. So how do you make that shortfall up? Well, what happens is you put in your percentages here as how much you want from loan one, how much you want from loan two, and how much you want from community shares. And it might be that you don't want anything from community shares, you just put zero in there, or you've just got one loan, it's 100%, and you know what the interest rate is that you want. But this gives you the idea of what the annual payment will be, and also it gives you the split between how much, based on that percentage, you will be spent on. It will be drawn from each of the types of loans and the community shares. The community shares, we put 1.5% in there. Obviously, there's no guarantee on that. Community shares, you don't guarantee an amount, but it gives you it gives a sort of target amount that you're paying. And we have 3.5% interest rate over 20 years and 5% on this one. It's just a split, and it's the sort of thing that you can actually play with different scenarios as to what you want to do. Obviously, the longer you keep a loan, the more expensive it is, the more money you pay out overall. But actually, it might make it more affordable because you're stretching it out over a longer period of time. And then you come to the profit and loss, which is at the bottom, and that shows you we start to put in numbers. These numbers are picked out from the income at the top, and then this just increases with inflation from there. The loan interest is picked out from the loan schedules, which are hidden at the bottom, which run from those loans, and the interest on shares is picked out from the share part of the financing schedule at the top. Agent fees is based on that number I showed right at the beginning, which is the 10% of turnover. And these numbers you put in, and once you put them in the yellows, then these just run, they just increase with inflation. You can overwrite them because they're green, so you can do your own overwrites there. And staff costs, again, that's just something you put in as a sort of an estimate, and they will increase with inflation unless you change them. Community wealth is actually showing what cash is left over at the end of if you're trying to keep a certain amount back, then the community wealth is just an idea of what you can actually give back to the local community, and then you can monitor what happens to the cash balance based on that. I'll show you that in a minute, the cash balance. But that's yellow, so you can just you can put your own inputs into that. So that gives you a profit, which is, this is generating a profit. Whether it's generating enough of a profit to repay the capital is one of the things which comes out in what I think is the next bit, which is the balance sheet. And so there you see the cash in the bank. So you can see it stretching in the over 30 years. Here's just a little extract of it, and we're looking at it. We don't just look at cash when we do finance, but it's quite a handy line to use, a handy line to look at, because all said and done, you're actually trying to make sure that you're able to keep that positive or within a known overdraft limit. and you're playing around with the loans and the grants and the loans held and the income to make sure that stays positive. We've got a shareholding line here, so just like a normal balance sheet, it's got the net worth, which is all the assets less liabilities, and it's got a financed by section of the balance sheet, which has got the members' shareholding and the members and the cumulative profit in there. So the members' shareholding, it doesn't decrease for the first 5 years here, and then it starts to go down there, and you can set the amount that you want it to go down, and I can't quite remember where that's set, but we'll look at that when we actually look at the model itself. So the idea is this little check in the balance sheet is to make sure that the net worth balances with the finance by, because that's the idea of a balance sheet, is to they balance. There's a huge play here with if you're keeping this positive, because you want to keep members happy to be paying back shares as they want to withdraw money from them. Really, it's up to you when you let money be withdrawn. And you have the long-term liabilities, the loans in there you want to bring those down, but at the same time, if you need the cash, you need them higher. So that's the jiggle. That's what we play with. And the other thing in here is the grants held. In capital grants only appear as income as the thing that you've bought with them depreciates. So the tangible asset, we haven't got that depreciating here. So we've actually, the grants, the 1.2 million of grants at the beginning is not decreasing at all in there. And that just matches the asset value, or it doesn't match it. But as long as this asset value stays at that level, the grants will stay at that level. If we start depreciating them, the grants will proportionally go down as well. But that's how the balance sheet balances. So you don't, by getting a grant for 1.2 million, it doesn't suddenly boost the balance sheet. That's not what it does in finance terms. It pays for. It just stays there as a liability until this asset starts depreciating. So I think I've done that really with the share movement, and there's a cumulative count on any money that's gone into wealth distributions, community wealth distributions in there as well. And this is this important results comparison chart that can be used. So if the pink line goes negative, then it sort of assumes there's no overdraft facility. So the idea is that there's a section in there for working capital needed. There's a little box in the top left that if it does go negative, you can add a little bit in, and that will increase the amount of loans and financing that you need. So I'm going to show you now the actual sheet with an example in it, and I'll move around that sheet. So yeah, just to make it a little bit bigger. Is that big enough? Is that Carol? Yeah, I can see you're there. I can't. Just see everyone else's smiley faces. So this is the sheet itself, and if it's too small, then give us a shout, and I'll play around with it. So I'm going to zoom zoom in or zoom out. No, zooming out. So there's the sheet looking very. So that would just print out on A3. So I think this is exactly the same example as we just looked through, which may be a bit handy. So we start off with these parameters that are in there. So we put in inflation, we put in the letting agent fees, the design and build percentage of cost. So I think I'm just trying to remember some of this. We had so many fantastic ideas of what we needed to include. I'm not 100% sure. I think this increases the So whatever the build cost is, it goes up by 12% to allow for design costs. Tax status, we put 19% unless we're a charity, and these are just sort of reasonable estimations for the loss factor. So we put those in. Then we put in what the likely income per square foot is, and it sort of jumps around a little bit between square foot and square meter, and there is a calculation down here between the two of difference between square foot and square meter. This is the costs in there, and then we've gone to then we input the areas. So these ones I've given some numbers in there, and they will stay there. These ones are very much yours. So you put in you go in your tape measure, you measure them up, and once you put those numbers in, and these are sort of like the key things, is actually what I really need is I need those prices in there, those numbers in there, and the price is looking to sell, and the rest can really be done. It will do it itself, and that's the really quick check. Is if you actually got one of these sheets and you put your areas in there, and then you can sort of look at what you want. So this uses a pull down. So if it's a heritage bit of work, it will change that. It's just drawing off that table that's below, and so you put refurb or whatever you want to do, and likewise with that. So that's pulling up from the area of the square meterage on that floor. It's pulling up the cost because of you're converting it to accommodation, so it costs X amount per square meter. Likewise here, you've got community retail, so you select what you want, and if it was community rate, then it will put in the pounds per square foot that you've put down the page here. So it's just drawing off those two tables. So once you've done a couple of them, or even just one of them, you'll see that actually the next check is a lot easier. Just make sure I haven't undone. Okay, sorry. So there's a bit of extra cost in here. There's estimated additional heritage and structural works that have been put in to here. There's a purchase of price of $250,000. So looking at the actual other costs of 20,000 and fees as calculated. So there's another all of those. So all of those costs, the refurb costs, times the amount that was down below of that 12% for fees on build. it's just giving you estimations, and so that's what comes up with this is the amount it costs. And if you find that you haven't got enough money, just try to find where there should be in there somewhere the extra amount you can get as working capital, but I can't find where that is. I'll just
Sarah's got a hand up, Brian.
Oh, sorry, I'm looking at my right hand screen. I don't see it. Yeah, sorry. Yeah, thank you, Sarah. Yeah.
No, that's okay. Yeah, it's very interesting everything that you're going through on here. Obviously, these are tending to look at it from a co-op and obviously a CBS perspective as well. We're coming from the angle of we are a community interest company, whereby we're going to be looking to actually buy. It's like a pub, public house. We're looking to actually buy the pub. How would we potentially use these spreadsheets that you have? What would be the best way for us to actually go about looking at these? Because we're in the process of looking at like different funding options. So we're applying for various grants, but obviously there's going to be we're looking at overall valuation and other methods of generating funding.
Okay. So you're looking at buying a pub to be a pub, presumably.
Yeah. So we basically saved it from as a group, saved it just over 3 years ago, and we've leased it for the past 3.5 years. Obviously with COVID, there's been various issues, but yeah. So we're into the next 3-year phase of leasing, but the idea is to actually go ahead and buy it outright. And just wondering how we could potentially use your spreadsheets and how we could potentially use those to look at that.
What this uses a lot is the value of rental space in there. Yeah. That's what all the presets are for. If you've got an amount where a business where you're netting an income or you suspect you can project that, then you can just put that number in there. So if you said actually our profits from sales during the year, effectively our gross profit, so the value of sales less the direct costs, and you say, well, actually that's 100,000. I'm not saying prejudging what it is. Then you would cross out all those in there.
Okay. So it just goes under the estimate additional heritage and structural works.
Yeah.
That part, yeah.
And if you knew that actually that you've got one space and you've and you know it's got £50,000 of work to be done in it, then you would put that in there. And then and then if you then went and said, okay, and the purchase price is, well, actually let's say 250,000. That actually sounds like a reasonable purchase price to go in there. So 250,000, but there are no other costs in there.
Okay. So no additional cost. Yeah. Okay.
So then you look and we look at the grant income, and then you can then look at that and you can say, okay, so the grants. Just trying to remember what these. So within here there's some in-kind costs as well. So I'm going to just cross those out because actually that sort of can confuse us. So
we're about to close soon.
Okay. So yes. So actually, what I do need to show you. But anyway, you see the point. So then you actually get you go down the bottom and you can see how you're doing. And
and then will this spreadsheet be shared with us so we can actually?
Yes. Now let me show you where to get to. So this is
Okay, great.
and I'm sure Dina will show you as well. So if you
gonna
go
say-
in, so we've got
gonna say,
87
Brian.
seconds to do this. That's great. So if you go into www.can.coop,
Yeah.
and you go into products and services, and this will be shared with you after as well, and you want to go into business planning and support and consultancy.
Yeah.
And then there it says Wicked Spreadsheet for the cooperative management of assets.
Okay, great. Thank you.
And so at there's the links to the webinar with Dina leading on it there, and there's actually the somewhere on there. There's the spreadsheet itself. So